A new look at the state of the U.S. housing market. The latest Case-Shiller home price index is just in moments ago, and it shows a stronger than expected price gains for October. Let's talk about it with Craig Lazzara, Managing Director and Global Head of Index Investment Strategy at S&P Dow Jones Indices. Craig, good to see you here. Pretty good month for the Case-Shiller.
It was indeed. The national index, the most comprehensive one, was up 3.3%, which is ahead of its pace last month. So we've seen a very stable and steady growth for the last several months now. That's quite encouraging.
What should housing market watchers look for in some of the data that comes for November and December? We've seen a big push higher in the stock markets. Do you think price gains will show more strength for those 2 months?
It's hard to make a direct equivalence between what goes on in the stock market and the housing markets. The thing I would say is that we've seen over the last year and a half, say, continued price gains, but at a lower rate, so a rate of deceleration. And that came to an end 2 or 3 months ago. So we've been very stable since then. Now, that may continue to be stable, or it may decline, it may go back up. The things that I think are more relevant to the decision about housing prices, or one's forecast about housing prices. I mean, housing is of course, very local. What goes on in San Francisco, which actually was down this month, the only one of our 20 cities.
San Francisco was down.
San Fran was down. The big leader this month was Phoenix, up I think 5.8%. Tampa and Atlanta were strong, and Charlotte was strong. So mainly the Southeast. And given how far San Francisco had run, it's not a shocker that it would be down. But the game was very broad-based. Well, that said, housing is a local market. The things I would look for are things equivalent to what you just mentioned a moment ago. Is there going to be a trade war, or is the economy going to overcome that hump and continue to grow? We're at record low unemployment rates, very low interest rates. Those things are both important in people's decisions about whether they can afford a house and how big a house they can afford.
What are you seeing on the housing shortage front? We were just talking a little bit off camera. My brother cannot find a home. He's getting beat out with people with cash in their pocket. It seems to be getting worse.
I think that's, again, very market specific. There are certainly places where that has happened and can happen. But generally speaking, the market, it's not robust in the sense that it was robust 2 years ago, but it's certainly steady and stable. I think the most obvious conclusion that I would draw from looking at the data this month and last month is that if people were waiting to see if house prices would actually decline as they did in 2006, 2007, that's probably not going to happen, at least given the current economic backdrop.
You also follow the markets very closely. It's been quite a decade. What do you think the next decade will mean to investors? You knew the question was coming.
I worried that it might be coming. I think we have seen an extraordinary decade, particularly in the U.S. If you look at the U.S. stock market has been far ahead of other developed markets, although, interestingly enough, Jamaica, I think, is the highest national market in the past 10 years. No pun intended.
News you can use.
No pun intended. But the U.S. has done very well, supported by very low interest rates worldwide. But as we said earlier, the U.S. economy is doing well. GDP is increasing, unemployment is low. When that happens, you expect the stock market to do well.
But how worried are you over the next decade? Interest rates will probably rise, and I think the market at some point will start caring about the country's debt levels.
That is indeed a possibility. The question is whether we can grow ourselves out of the debt burden that we now have. The market doesn't seem terribly concerned about that today. You can certainly envision circumstances where that concern would leap to front of mind. I think the likelihood of that happening depends greatly on the strength of the economy. If the economy begins to decline, whether because of supply shocks, tariff wars, anything that things that we can't think of now, otherwise they'd already be compounded into prices. But whatever might happen to slow the economy, that would be the thing that would cause the stock market perhaps to begin to decline. And in that environment of slowing economic growth, there you might see more concern about debt levels. Absent that, the market seems to be comfortable.
Well, we'll leave it there, and we'll bring on 2030.
Look forward to it.
Here it comes. Craig Lazzara, good to see you.
Thank you, Dre.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.